Interesting note today. I'd love to get you to clarify your recession risk view, because you say a U.S. recession is not your base case, but then you say that equities typically peak shortly before the start of a recession. This time it may happen earlier because we have elements of a deflating bubble. So what is recession risk right now?
So, our economic view would be that there's probably a 50-50 chance of a recession in the 2023 timeframe. So we've been modeling out, a base case that assumes a soft landing scenario for the S&P, which has enabled us to be somewhat more constructive for the better part of this year, tying back to our, longstanding 4,700 target for the market.
Do we think the 10-year gets back to 320?
The house view here is that the 10-year, by the end of the year, falls back towards the 245 level. I would say, importantly, though, we're keeping an eye on nominals as well as real yields. Real yields have nudged a little bit above zero. The point we've been making on this, that I'd like to stress, is that as real yields move above zero, in our view, the connection to price action begins to lessen, particularly for the growth side of the market.
I'm curious, we have the banner there saying that Citi downgraded U.S. stocks to neutral, and you believe that stocks could peak before we reach a recession. Do you think they already have peaked at this point if we're looking, say, into 2023 for potential recession, even if it is a soft landing?
Right, so I'm going to turn the discussion around a little bit. So our global strategists have taken the U.S. down to a neutral stance, okay? From my view, looking more specifically at U.S. equities, again, the way we're thinking about this is that the bulk of the rising rate impact has been felt on valuations already. It's been a particular issue for the growth side of the market more so than the value side of the market. What we're still concerned with here, though, particularly as we move into the Q2 reporting period, is that we'll begin to see C-suites begin to lower guidance, if you will, perhaps for the second half of this year, but we still think the 23 earnings outlook becomes the big swing item in how we think about recession or not. What I would highlight in our work looking historically, and this is, I think, very important to keep an eye on, is that historically earnings have risen while the Fed is actually tightening and raising the Fed funds rate. Essentially, the Fed's responding to strong economic activity, and earnings respond to the strong economic activity. Historically, it's once the Fed actually begins to stop raising that you begin to see the earnings risk, if you will, to the market. Again, that would sync with weakening economic conditions and activity.
That's interesting, because I've heard so much about just the uncertainty of rates and the challenge that poses for investors. But it sounds like you're saying that it's not so much the actual delta and rates increasing, but it's once they do actually reach a level of stability that then you start to see more of a negative reaction on the earnings part of the equation.
That's mostly how it's played out. And so it kind of comes back to the same, issue that we're contending with in the market, to your earlier question. The market has been quick to price in recession risk, and we've been highlighting that it actually is pricing in recession risk, but not the actuality of a recession itself. So let's frame this. Our base case recession scenario had been 3650 on the S&P. Again, my official year-end target is 4700, which we'll call soft landing. So as the market, sold off below 4,000 within mid-single digits of that, let's call it recession scenario, you began to look at a risk-reward to a soft landing scenario bias on the side of reward, if you will. I think that kind of helps to put some perspective on the move we've seen over the past several days. And then also what you have to consider, though, is that we're still essentially discounting recession risk for a recession possibility that's many, many months out. So in between all of that, we have to expect continued volatility. But again, our point here would be the bulk of the rising rate influence priced in. The focus begins to shift more maniacally to the earnings side and earnings expectation side of the discussion.